What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Man, am I excited to bring you today's show and guest. Founder and CEO of 42 Macro, Darius Dale, joins me on the podcast. All I'm going to say about today's show is Darius believes inflation is coming in the next 2 to 3 months. That's all I'm going to say, because I have to tell you, it totally surprised me that he thought deflation was coming as soon as he said. And today's show was all about going through slides. So if you're listening to this on audio, you may want to shoot over to YouTube or anthonycrudele.com to watch today's episode about his reasoning for deflation coming. And not just his reasoning, what assets he thinks that traders and investors should be allocating to when deflation hits. Futures Radio Show is sponsored by CME Group. Hey everybody, micro Bitcoin futures are here. I talked about this in the podcast last week. Huge start to this product. Third biggest day in volume in CME Group's history for a product launch, only behind the micro E-Mini S&Ps and the E-Mini S&P. This product is already off to a massive start. To learn more about micro Bitcoin futures, go to activetrader.cmegroup.com. And at just 1/10 the size of one Bitcoin, TradeStation gives clients access to trade micro Bitcoin futures using an institutional grade. Forget platform fees. Trade your way with TradeStation. Remember, you can listen to Futures Radio Show podcast anywhere where podcasts are available. But if you want to watch Futures Radio Show, you can check us out on YouTube or anthonycrudele.com. This show is also sponsored by Trading Technologies and FTSE Russell. The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 futures symbol RTY and micro E-Mini Russell 2000 futures symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. Darius, welcome back to the show, my friend.
Hey, Anthony, it's great to see you, man. How you been?
Great to speak with you. Everything's really good. You and I last spoke, I think it was really pretty much right at the beginning of COVID. So it's been almost a year. I know you got a new gig now. You're a founder and CEO of 42 Macro. So first off, congrats on that.
Thanks, man. I appreciate it. It's a long time coming.
Yeah, and I've always been a big fan of your content. And right now, all of the macro people that I listen to, pretty much at the beginning of every podcast, they all talk about, are you someone who's seeing inflation? If so, is it transitory? Are you a deflationist? Is it stagflation? Where are you with that?
I'm a regime guy. I don't think you need to define yourself and pigeonhole yourself into one of these classes, because the reality is the market will reward investors for being in the right asset classes and exposures according to where you are in these rate of change cycles. So there are times where it pays to be an inflationista. There are times where it pays to be a deflationista. There are times where it pays to bet on both or short both. And so the reality is, my entire process, our process at 42 Macro, is designed to understand where we are in those cycles, where you are in the rate of change cycle for growth, where are you in the rate of change cycle for inflation, put those things together, and then understand with careful back testing and careful market observation, what the market is pricing in from a regime perspective. And so we've obviously very clearly been in reflation since, for the bulk of since we last spoke. And the reality is, I think the big question that investors need to ask themselves is, how prepared are they for the eventual transition out of that market regime?
You're very present as to where we are right now, is basically what I'm getting from you. You're not really looking too far beyond it, because you just want to look and give all of your clients the information this is where we are right now, and you say that's reflation.
Yeah, and it's more about, this is where we are right now. These are the highest probability outcomes in terms of where we're likely headed. And this is the path the market is likely to take to price that in. Now, I have a view longer term that we jumped the shark from a fiscal and monetary policy perspective for a variety of reasons. And that, that the net result of that is that we've been in this, long-term secular transition or secular theme of lower highs and lower lows in inflation at every cycle, in every recession. I often believe that we've undergone a paradigm shift where it's very likely that we see higher lows and higher highs going forward from cycles from this point on. We can unpack that later, but that doesn't necessarily have to impact my asset allocation today. It currently does, but it doesn't. I don't need to put that on in size today and have that on in size every day going forward. I need to put that on in size when the market cares about it.
Absolutely. We always say as traders, nothing matters until it does. I mean,
Mm-hmm.
and when I look at your content and the things you talk about regimes, and then right now you're saying reflation is where things are, and your asset allocation is X in this regime right now. So, what
Mm-hmm.
is the plays that you're looking at right now for this reflation regime?
Yeah, so in terms of how we think about asset allocation, it's again going back to the back test and understanding things like expected returns, things like percent positive ratios, volatility, covariance in the various regimes. We can use that data to construct or at least to isolate the exposures that give us the highest risk reward setups for different styles of regime. And so when I think about where we are currently today, we're in reflation. That's what the market is telling us we're in on a trending basis. But the reality is we need to start to think about the next macro regime, the bottom up economic regime the market will start to price in. And for us, we believe that's a transition to deflation. Let me take a step back and explain to your viewers exactly what I mean by all these words. So if you think about the world in growth terms, in inflation terms, from a rate of change perspective, you kind of wind up in four distinct scenarios. If growth's accelerating and inflation's decelerating, that's what we call Goldilocks. You move over to the right on the grid chart. You got growth and inflation accelerating at the same time. That's what we call reflation. That's where the economy's largely been in since the bottom last April. And then you have with growth decelerating on a trending basis and inflation's accelerating or still accelerating. That's inflation. That's you typically see like the first big down move into recessions where the market starts to give way. That's where you typically see that type of price action. And then lastly, obviously, as you sort of progress throughout a recession or a deeper slowdown, that's when you wind up with both growth and inflation decelerating at the same time. So, what we're effectively saying is we're going to go to some very asymmetric highs in growth and inflation, in the springtime here, growth, April, May, inflation, June, July. And then from that point forward, very likely we start to, decelerate pretty meaningfully. More so on growth than inflation, but the reality is, that's a very different economic dynamic and economic setup than what we've experienced coming off the lows of COVID.
I get it. And I want to go to the markets that right now you're going to be focused on, because in this reflation regime,
Mm-hmm.
where are you most focused as to where you see the highest probability of a trend continuing? Is it in stocks, and what is it in?
Yeah, it's unequivocally in commodities currently.
Okay.
I mean, when you think about, things like, I mean, you pick your commodities, but the broader CRB index is very bullish from the perspective of our risk funnel. CRB raw, all the components in that. Corn obviously looks like a chart of Bitcoin, or Bitcoin used to. Corn is the new Ethereum, I
That's
guess.
crazy. I know.
Crude oil is even up today as the market is getting smacked down. So, it's very clear the commodities market is clearly signaling to investors that they're not fully there yet in terms of fully pricing that in, and B, that this trade could potentially have legs when you think about it from a broader global macro risk perspective. The markets are interconnected, and they all move generally together in terms of signaling the same market regime. You're not going to have equities in a bear market and commodities in a bull market, or bond yields breaking down and equity volatility breaking down. Things like these things tend to rhyme when you look at them from a regime perspective. And when you add up all the signals in our global macro risk matrix, we look at 32 different asset markets across 4 different primary liquid asset classes, and the signals continue to overwhelmingly support the fact that the market regime is in reflation. Now that could change. It's certainly not changing today, and it's not going to change tomorrow. But over the course of a week or 2 weeks, it could very well change, and we'll have to adjust when that does.
You use data for a lot
everything.
of, yeah, for pretty much everything, right? And
Yeah.
I've said to you before, I'm not somebody who looks at a ton of data. I go to you to see what you think of the data, and then I look to see how it fits into my trading. Got a bunch of data out this morning. Actually, pretty busy day for it. We're recording here on May 12th. Actually,
Yeah,
got quite a
very.
bit of data. Actually, lately we've gotten some decent data. What are you looking at that will still confirm to you that we are in this reflation type trade? But obviously, when something starts to change, and because I've gotten to know you over the years, you're going to look at the data, and that's where it's going to tell you. You know, it's not going to be the prices of the market, because although commodities have continued to come up, they might come down a good bit,
So,
but that's not going to be what changes it for you. Correct me if I'm wrong. It's going to be the data. So, what are the
uh,
things you're
yeah,
looking at?
yeah, I'll correct you slightly. It'll be a combination of both, right?
Okay.
Like the market will always front run the data. The market is a lot smarter than whoever is recording the statistics at the BLS or the
Yes.
the BEA. And so the market has a general sense of these inflection points. And again, the rate of change of the data, the trend in the data, the trending rate of change is the real key variable investors need to solve for when you think about these primary, these principal components of asset class returns, i.e. growth and inflation. And so in terms of what I'm looking at, it starts with the data, but it's confirmed with, not only the realized data from a market perspective, from a macro perspective, but it's also, confirmed at the margin in terms of how our forecasts evolving. And right now, in terms of how our forecasts are evolving, we're clearly getting upside surprise momentum in inflation. You got a very hot inflation report today. I mean, you look at stuff like cars up, nearly 10% on a year-over-year basis. Obviously, core inflation is doing its thing. Energy prices are up 25%. So when you crack open the egg, you have a broad-based acceleration in inflation, and that is, contributing to upside surprises over the near term with respect to our forecast. But the reality is, when you think about the medium term, like 3 months from now, 6 months from now, really that 6 to 9 months from now period, it's still likely that inflation and growth are decelerating on a trending basis in that time frame.
You know, traders always say to me, how do you know when these trends are going to end? And I always say indicators for me, I'm more technical than I am macro, but
Mm-hmm.
I find it so difficult to even identify when these trends are going to end. I mean, this commodity trend, boy, I mean, I could have bought corn so many different times. And
Totally.
as a trader, a lot of time you look at the charts and you're going, man, this thing is, how far can it go? It's just, it's so difficult to determine that. And that's kind of why I was, I guess, leading more towards you'll wait for the data, because even during that time, we've seen some volatility in a lot of these inflation plays to where you're like, okay, is that
Mm-hmm.
it? I mean, look at oil. A lot of people are like, well, maybe it's done for a while. And you go back, I don't follow corn and soybeans as much, but how do you go about really transitioning from that one regime to the next, to where is it? I know we said it's price. I think you just kind of went into it a little bit. It's price of the market confirming with the data. But how do you then take us through what will you be looking for actually to then say, I'm now the regime has shifted? Because I think that's an important piece, because
Mm-hmm.
I as a trader, as an investor, some people might be in and just holding through a lot of the volatility, but all of a sudden
Yeah.
price may come down, and then like, data, it's like, when do you actually get out of something like that and shift?
Yeah, that's a great question and phenomenal question. I will say, I'll start by saying, if you're looking at the world through a macro lens, my primary responsibility as a macro risk manager is to help our clients and subscribers not lose money. Certainly not lose money because of macro, but I'd like to think that macro is the tool, is the skill set that you have in your toolkit that allows you to avoid major drawdowns, volatility, bouts of volatility in and across asset classes. And so, what I'm primarily focused on in terms of timing these regime changes is, one, orienting myself according to what the regime is, and then starting to tiptoe into the next regime because I have an accurate view, or at least we think we have an accurate view ex ante on where the economy's headed, both domestically and abroad. And so, as you think about, how our process really works from a systematic perspective, it's every month I get closer to a new realized regime in macro, I got to start to shift a greater and greater proportion of my assets into that regime in anticipation of the market regime changing. Now, the market regime may not change, so the whole point of the process is to be systematic about it and doing it in a piecemeal fashion, that doesn't sort of get you all in or all out or back and forth, which a lot of investors do, right? You certainly see that amongst, junior traders, younger, more inexperienced investors tend to do, they're all in, they're all out, or they're making these wholesale portfolio changes, all at once. And the reality is timing these regimes is really hard. You don't know if you're in a new macro regime until it's confirmed, right? We have a process for confirming it. Again, we're scoring volatility adjusted momentum signals across 32 different key asset classes to give us a cumulative signal on, okay, what are all these things signaling in unison? What is this pattern saying? And right now the pattern is saying that, reflation is the modal outcome from the perspective of that model. But the reality is you've had a couple bouts, if you go back to late October and you go to the early March of this year, where very, very narrowly and for, a day or two, you went into one of those negative grids, in terms of inflation and deflation, but it was transitory. And so it's our job as investors to say, hey, when I'm in this awkward transitory patch, is it transitory? Well, what would make it transitory? Well, it doesn't agree. It doesn't agree with the data. It doesn't agree with the outlook. What would make it not transitory? Oh, this is happening right when it should be happening from a macroeconomic perspective. So, right now I think it's less likely that we head into a deleterious market regime at the current juncture, because we're not quite there yet from the perspective of the underlying economy.
Piecemeal. That's what you said. You piecemeal it, because I think that's really what I was looking for from you, is like, how do you go through that transition? Because I feel like, obviously, once you say we've gone from one regime to the next, it's now definitive in your mind, because you're seeing data, you're seeing price confirmation, you're seeing all these things. But at that point in time, the markets could be so far back. It's so difficult to transition from one to the next. And like you said, you piecemeal it. And it's once you start to see signs, you start moving that allocation out from one to the next. So it's not all in and all out. It's easing in, easing out. So that brings me to my next question. Where are we right now on your current reflation regime? Are you starting to leg out towards other asset classes? Like, where are we there?
Yeah, so we're T-minus 2 months away from deflation being realized in the macro economy. Again, to remind investors, deflation is where growth and inflation are decelerating on a trending basis. Now, I happen to think the upside surprise in today's CPI report might give us some forecast error, in the sense that the deceleration in inflation might actually commence a month later. So that would make us potentially wrong on that point. But the reality is, it's pretty clear that by the time you get to July, you're going to be decelerating on a year-over-year rate of change basis and growth. And certainly by the time you get to August, I would still say July currently, but definitely by August, you will be decelerating on a year-over-year rate of change basis in inflation. And so the reality is, right now, the whole world is hyper concerned about inflation going to the moon. It's 5% next. But the reality is, you have to be able to understand where you are in the context of that sine curve in order to fade it. If you don't have accurate forecasts, or if you haven't studied the time series long enough, or understand the critical thresholds of the time series, it's going to be very hard when you see a 4.5%, 5% headline CPI print in a month to say, hey, I got to start pivoting towards a deflationary macro regime and actually allocating assets, in accordance with or in advance of a market regime shift.
So just to confirm everything you said, you think we're 2 months away from that shift happening from this reflation regime to deflation.
Yeah, it could happen tomorrow. It could be, again.
We're close.
I'm humble enough to know, I've been doing this long enough to know that
we don't know.
It's a fool's errand to say it ex ante. Yeah. All I can do is wake up at 4:30 every day and refresh the models. And could we be at the beginning part of that transition? Very much so. Yeah, absolutely. Anything could happen. I happen to think, based on the calendar, that it's unlikely that we actually get into realizing those kinds of economic statistics. It could be we're a full 2 months away from actually recording, and a full 3 months away of actually observing those kinds of data. So it's unlikely, in my opinion, in my estimation, from my own experience, that we are at the start of that process. But again, anything can happen. It's not my job to tell the market what to do. It's my job to do what the market wants me to do.
Absolutely. It's just so funny. It's like we've been doing this long enough. We know we're smart enough to know that we don't
We're
know.
not. Yeah, absolutely, man. It takes you a while. I mean,
It does.
4 or 5 years ago, I'd say probably like 2016 Darius, where I was probably this smart and definitely not as experienced to not know what I didn't know. I would have definitely given you a different answer there. But I've been around the block a few times on these growth and inflation cycles and these market regime phase transitions. Obviously, I have a pretty good track record for my former shop. So
Yeah, and you know what I want to do is, traders, we're going to pause here for 45 seconds, and when we come back, I'm excited to do this. We're going to be
yeah,
having Darius share some slides with us and some of the information he has out there for his subscribers. So I'm very excited to see this, and we're gonna dive deep into a lot of what Darius has out there and what he's looking for on the macro side of things. So hang tight, traders. We'll be back in 45.
Replace your exchange with TradeStation Crypto. Dealing with multiple exchanges is complicated and it takes time, except with TradeStation Crypto. Because we are not an exchange. We are a broker. You have access to multiple pools of liquidity. All in one platform, in one account, one way. Trade crypto your way. Plus, earn interest on your eligible cryptocurrencies. Get started in one click.
Trade the global markets with Trading Technologies. TT is the world's fastest commercially available futures trading platform, now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Learn more at tradingtechnologies.com. Welcome back, traders. If you are listening to this on audio, you might want to shift over to video. Remember, Futures Radio Show is now on video. At the beginning of this year, we moved to video. You can go to YouTube or anthonycrudele.com to check this out, because we have Darius going over some slides. And so far, this conversation has been about what regime we're in, and that's reflation. And Darius is talking about how within the next couple of months, and we both talked about how we don't know exactly when, but he feels that we're near the end of this reflation turning into deflation. And I think a big thing for traders is to see how he's thinking and to go over some of these slides and go through Darius's eyes as to how he's coming to these conclusions. So Darius, I'm going to leave it to you. Explain to everybody what we're seeing right now.
Yeah, absolutely. Thank you, Anthony. So just going back to this concept of timing regimes and understanding what the market's doing and what the market wants you to do, and then also having an idea of where the market might be going next. We think about the world again and through the prism of distinct regimes. In fact, I'll show you a chart just to kind of give you a better sense of this, because I spoke to it earlier. When you're in a situation where growth is accelerating and inflation is decelerating, that's what we call Goldilocks. That's the top left corner of this chart here. When growth and inflation are both accelerating at the same time, that's reflation. That's largely where we've been since the second quarter of last year. Growth down on a trending basis, inflation up on a trending basis. That's what we call inflation. And then lastly, obviously, when you got growth and inflation decelerating at the same time, we call that deflation. So that's how we think about the world. This is the U.S. Sort of model, but we model every OECD economy. So going back to how we think about asset allocation, it's okay. We understand how the market has historically responded to those economic forces, those cyclical economic forces, and we understand it so much through the careful back testing and understanding again of things like covariance, volatility, expected returns, et cetera, that we know this is roughly around the kind of asset allocation you should have in each of these regimes. Starting with Goldilocks, again, growth up, inflation down. You want to be, overwhelmingly in equity and commodities, in fixed income and FX, but obviously taking a lot of credit risk, a lot of cyclical risk from your currency exposures. Reflation, that's even more in equities and commodities, and that's obviously something that's really rewarded investors in the last year or so. And when you think about your fixed income and FX exposures, even more credit risk. Get the heck out of duration. Short duration is the name of the game, and going down the capital structure and out in the credit spectrum. And the opposite is true when you're in the other two regimes, right? You want to actually, you want to start to high grade your portfolio from a fixed income and equity perspective. You want to start to get into lower beta plays, more size, more dividend yield, more things of that nature. So the concept of, how do we go from this to something that's basically the opposite is the $1 million question for market participants, for traders, right? It's hard to, make wholesale portfolio changes. So what we've done at 42 Macro for our customers is really sort of think about this very systematically and actually measure, map out, using, again, careful back tested data, a process that allows us to go from, this very, very awesome, very positive reflationary regime to one that looks very different, both from an economic and potentially from a market standpoint. And that really starts with using the calendar and using our forecast as weapons, really. We want to weaponize our knowledge base and our ability to forecast the economy and use that and actually start to leg into asset classes, leg into exposures that will be confirmed, that'll eventually be confirmed by the market regime transition. Now, again, we could be very wrong on the forecast. The market can never transition, and that's a problem in and of itself. But the reality is, if you're doing this, you never have perfect information. We're always operating on an ex-ante basis as investors. And so ex-ante, when you're 3 months out from an economic transition, you want to start to have, maybe 10% of your assets in the other asset, in the other asset allocation framework in one of those different pies. When you're 2 months out, it's 20%. When you're a month out, it's 30%. And, typically somewhere between a month and 2 months out, the market is actually already starting to transition. And certainly by the time the month starts, the market will have fully completed that process. The only time I can really think of in my career where it was very coincident was Q4 of 18, when the U.S. economy, sort of slammed into deflation.
Seeing this is extremely helpful. This goes back to that question I asked you about the transition from regimes, because like I said, I feel like whether you're macro or technical, you never really know when these trends are going to change. And by the time we truly know they do, I don't care what indicators you're using or what data you're looking at, the markets have already responded and they're probably reverting back. And then, like you said, for some traders or investment managers, they're just all in, all out, and it's very difficult to gauge that. With this, I really like this because it gives you the visualization of how you transition, even though, like we said, we don't know when it's going to happen, but you start to make that move. And at least in your mind, you're committed to the execution. I said the other day on Twitter, indecision is so much worse than wrong decision. You don't know when this is going to happen, right? But you're decisive on how you're going to do that transition. And from there, then, and unless the story really changes, you're already moved as it's changing, right? So you're not going to it's not going to be a quick flip flop to where all of a sudden, hey, well, know what? Reflation is back, and for so many more months, you're already you don't have to time that perfectly. You're just it's slowly happening.
Well, the reality is lucky. The only time you time it perfectly is when you get lucky. The market is not going to call you or text you and say, hey, I'm transitioning to a different regime. Exactly. And that's the point of the process, right? Like, when you look at all the different asset classes that we are modeling to get a sense of what the market regime is, it's very diverse. Every morning I refresh this model. I'm calling the DAX, I'm calling the MSCI EM index, I'm calling the NASDAQ, the Nikkei, so on and so forth, all the way down to high yield OAS and real interest rates in the US. Looking at currency vol, looking at currency pairs, looking at all these different markets to signal to me in unison. And when I add up all the different signals, what is the market regime? What market regime is getting the highest representation across all these global macro signals? Because the market is not going to lie. Again, I mentioned this earlier. You're not going to have, a breakout in equity volatility and a breakout in commodities. Certainly not on a trending basis. Obviously, we have some variation of that today, but it's not going to be something that lasts for more than a week or two. If it, so you really start to look at the world. When you have a regime segmentation process, you really start to think about the world through the prism of the regimes, not through the prism of these individual features in the model. It's what are all the features in the model singing together. And right now, they're singing reflation, we are headed to a deflation. We could take a cup of coffee. We could have a cup of coffee and inflation for a month, but the reality is the real big sort of, the next big 6 to 9 month trade investors need to get right is when this blue line is the highest line on the page. That to me is the real key question. It's going from, the green line being the highest line on the page, the blue line being the highest line on the page. Now the red line can take a cup of coffee from you, for a few weeks and maybe even a month. But the reality is when do I buy treasuries? When do I get really big in gold? When am I in, max defense from an equity sector and style factor perspective? That to me is the next big trade. But right now, I don't think that the market is really rewarding investors for taking that risk. And that's the one thing. I don't want to ramble, but I think that's another important point. When investors talk about, I think we're having this phase transition in inflation. I'm an inflationista. I'm a deflationista. What they're really saying to me, and what they're really saying to you, Anthony, is that they don't really give a damn about what the market is saying. They believe that they can infuse their views upon the market. Now that's ignoring this entire process. That's saying I'm not going to be blue or gray in this chart. I'm going to be orange, and I'm just going to stay orange. And no matter where I am in the context of the market regime or in the context of the current impending macroeconomic regime, I'm just going to be in an orange circle. Now you can make a lot of money over a long duration just staying in the orange, different color circle, ignoring all these cyclical dynamics. But the reality is, if you do, one, you got to get the trade right. But two, what you're going to suffer are drawdowns, volatility, indecision, selling the low, chasing the high. Those are the kinds of things you do when you are not macro aware and you're agnostic to cyclical forces in the economy.
This is one of the things I've always struggled with a lot of the macro traders I'll talk with, is that, like you said, it's just, this is what they are. And I always say, as a trader, I have to go with the market's proven to me. And how can you just be that way? How could you handle trading through all that volatility? I've talked about this so many times on the show, and there's a lot of really good macro traders out there that'll say, well, I'll use technicals or I'll use other things, what you're showing us here today. And you're not just sitting in this idea until all of a sudden that idea doesn't work, because it's just too volatile to be able to do that. And by that time, it could be too late. You don't know. Things change. I want to talk about this, and a couple of things I want to talk about here. First is looking at this as a complete 180, really, from where you think people need to be positioned now to where the way that they're going to, or should be positioned, and not too long from now. That to me is extremely interesting, because you're basically having to, it's like I said, it's a 180 of reallocation. It's a lot. You're going from, right now there's equities and commodities, and you're saying the next thing is fixed income and FX. When I look at it, and you said that gold and treasuries are a big play. So when this starts to change over to deflation, you're saying that the big areas are fixed income, FX, gold. That's the next big move. Okay.
Yeah, I'll give you a quick chart on that. So I'll walk you through some portions of our process. I don't give away.
While you're getting there, I'm just curious as to why gold. I mean, isn't gold the hedge against inflation? Why, if you think deflation is coming, that gold is the answer? I mean, educate me here a little bit, because I've been under the thought process that gold is a good hedge against inflation, a hedge against central banks.
Yeah, that's a great question. So how I answer that question is through the lens of what the market has told me. I'm not smart enough to tell you why to actually answer the question without using math. The reality is gold has an annualized expected return of 9.5% in the deflation regime. Now I can rationalize that based on my interpretation of how macro markets trade. You have real interest rates falling in that regime, and that tends to be very positive for gold. It tends to be positive for the dollar, and things of that nature. More defensive type plays. So the reality is when you look at things like annualized expected returns, percent positive ratios, volatility, covariance across asset classes, across regimes, across different styles of regime. What's the Fed doing? What's growth and inflation doing from an outsized delta perspective? What's the rest of the world doing? What's fiscal policy doing? You sum all that stuff up, we wind up with, what does the world look like from a reward risk perspective? What does the world look like from an expected return perspective based on my expectations of what's going to happen in the economy? Now, again, your expectations of what's going to happen in the economy could be very different. Like, what was everyone's expectation for what was going to happen in the economy on February 1st, 2020? Yeah, totally. It's just things happen, stuff changes. But the reality is, until something changes, you need to be, and this is why the process is anchored on doing what the market wants me to do and then tiptoeing into what I think the market is going to do next. It doesn't start with, I think, therefore, I think the economy is doing X, therefore. And I think that's, to me, is where I think a lot of investors, really struggle in terms of asset allocation decision making, because they say, I think, therefore. I think, we've transitioned to a new inflation regime, and therefore I must be long XYZ, it's gold, or it's something like that. And the reality is if the market's not rewarding you for taking that risk now, it's telling you you're wrong about the cyclical dynamics in the economy. That's it. That's just it. And maybe you might be right at some future interval. If broken clock is right 2 times a day, and but the reality is, why sit there with dead money, or worse, a drawdown? You could be positioning yourself in assets that are getting rewarded by the market. Now, again, if these phase transitions are very difficult, they're very hard, you're not going to nail it. You will take some pain in the transition process, as we always do as investors. Anybody who's doing this with live ammo realizes that. But the reality is that's better than just staying in one static asset allocation, or just having one or a handful of thematic macro views that at any given time could be being punished by the asset markets.
That's one of the things that I really like about your work, is that you're going about it obviously through the macro side of things, but you think about it a lot like a trader or an investor. I think that's a very important part of this conversation today. And I know for a lot of the day traders out there listening to this, they say, well, how does that actually help me as a day trader? And I'm one of those people that is a day trader. I'm an investor as well, but I think they're just two very different in the way, obviously, I go about investing versus trading. But something that I learned from watching macro guys like you is that when that theme is present, it makes me recognize why this bigger picture move is happening, and it gives me more of one side of the market to focus on during what we'll call one of your regimes. And I'm still trying to wrap my brain around, I'm somebody, who has been really bullish gold, because I thought gold was going to be a great way to fight inflation. Did well at the end of last year. This year, it's been my biggest loser. It's been hard for me. I've moved more into crypto. I might get to you with that in a second, but I'm curious the repercussions, because before we get to crypto, what are the repercussions of this deflation coming? What does that mean for the stock market? What does that mean for commodities? In my mind, I pretty much know what you're going to say, but I'm curious, if this starts to happen, where are you going to see repercussions in trends that have already been happening?
I think we're already starting to see repercussions. I think, look no further than Miss Cathie Wood, who, absolutely tonned it, probably made as much money as anybody in finance last year. But it's clearly done. That trade is over. The most speculative part of reflation is ended. It's pretty clear. You can look at that. One of the things that I look at on a pretty consistent basis is dispersion across U.S. equity sectors and style factors. Because I think dispersion will tell you a whole heck of a lot about what the market thinks. The global macro edifice, things, looking across global macro from an index, commodity market, currency market, and fixed income market perspective will tell you what the regime we're in. But when you look at it from underneath the hood, from a dispersion perspective, it'll say, hey, yeah, I'm agreeing with the regime, or more importantly, I think I'm moving to something different. That's where the market really has a lot of information for investors if they're paying attention. And to me, when you look at things like Tesla, and again, this chart here on the right is looking at the month-on-month Sharpe ratio of the 50 out of 50 U.S. equity sectors and style factors, and showing the dispersion between the top 10 and the bottom 10. And so, this is, a pretty representative sample of the different styles and sectors that you can actually invest within the U.S. equity market. And when you look at what's at the bottom of the dispersion table, it's, high flying stocks like Tesla, it's IPOs, it's tech, but more importantly, it's the, the ADRs and the high flying bubble stocks and the kind of the valuation doesn't matter stocks, those types of things. I'll put Netflix in there as well, the SPACs. So the market is telling you that the clock is ticking on. The market was already prior to this week, prior to this, sort of drawdown, or this, I would call it a drawdown. It's a very minor correction. Yeah. Prior to this minor correction, the market was already saying, hey, like the liquidity spigot is kind of running dry on people's willingness to chase those types of exposures to, really asymmetric highs. Who's going to be the buy, or I don't know, I can tell you what the price of many of these things are, but who's going to, let's say the price of the most shorted growth index is, 150 and on its way to 200. Well, who's going to buy it at 201? And this is what the market is telling you, is that there's no one to buy it at 201. And more importantly, there might not be anybody to buy it at 145. So this is kind of the process of the market going in unison, in aggregate, saying, hey, with my marginal dollar of capital, I don't want to go there. I might actually buy some gold. I might actually buy some treasuries. The yield is high enough for me to rotate from a asset allocation perspective. So I think that's the conversation the market was already having since going back to February, and now it could potentially be having that now. I don't think it's having that now. I think we're just having another sniffle. We have these things all the time. You can lose a lot of hair worrying about market sniffles, but the reality is, if we were doing this 6 weeks from now, I would say this is probably not a sniffle.
I don't even want to think about losing any hair, Darius. There we go, this show and everything.
Mine's already gone too, man.
Boy, things would not be good for me. No, but I want to go to crypto because I have never. I don't know if do you have some slides here for crypto possibly?
Oh yeah.
Oh, okay.
Ethereum and Bitcoin.
Okay, well, here we go, because it has been a massive shift for me this year. I've almost only been trading Ethereum. I've talked about it on the show. A little bit of Bitcoin. I'm probably going to start getting back to some NASDAQ now because it's moving again. Maybe some S&P, a little bit of oil here and there. But these moves in crypto are just unbelievable. And how do they fit into your regimes?
Yeah, no, I don't care if it's crypto or dead squirrel. I mean, if it has a time series, I can back test it against those regimes, right? And so what we find is that when we back test something like Ethereum, for instance, it loves 3 out of the 4 regimes. The only regime you really have to be concerned with is, oh, by the way, the one we're likely to transition to in the middle of the year.
Deflation.
And so, you look at in terms of how to read this chart, the top left bar chart is showing the annualized expected return in the months where you're in these different types of regimes. So again, I've mentioned Goldilocks, reflation, inflation, and deflation. You have a minus 73% annualized expected return on a monthly basis when you're in deflation in Ethereum. So it's telling you most of the returns to the upside are being concentrated in these other regimes. So that is important information to know, that, hey, when the market goes in this regime, maybe you might want to start thinking about booking gains, because at least historically, that's where investors have been sort of punished for overstaying their welcome. You look at the chart up here to the right, the percent positive ratio. You go from 100% in Goldilocks or even 62% in inflation, and again, these are monthly statistics, to something as low as 40% in deflation. Now, still, it's not zero. You still have a chance to make money, but from the perspective of going from something that's super positive to something that's super negative, it's very unlikely that you do, right? And so that's something to keep in mind. Pretty interestingly, the volatility profile of this asset class doesn't really change across regimes, and that's probably something that's more endemic to the fact that it's a nascent, kind of a young asset that really hasn't really figured out where it belongs in institutional portfolios yet. So it's just very volatile. There's not a lot of liquidity on the bid or axe in these asset markets, and there will be over time. I certainly think digital assets are here to stay and really potentially provide a lot of value for the world in a myriad of ways. But the reality is, until these volatility parameters come down, it's very unlikely that you see full wide institutional adoption. And it's kind of a chicken and egg thing, I realize. So it's going to increasingly require certain institutions to kind of take the risk and tiptoe into the asset class. And that's something I expect to occur over the long term.
Let's go to Bitcoin now.
Yep, absolutely. So yeah, even more clean, a little bit more data to analyze than Ethereum, obviously. The skew on the annualized expected return in Bitcoin is even more ridiculous. When you talk about, going from Goldilocks to reflation to inflation to deflation, the percent positive ratio is just a stair step down. Like the crypto, just like equities, just like commodities, loves Goldilocks and inflation. Bonds, just like the dollar, just like gold, love deflation and inflation. So our job as investors is to understand if you're putting together an asset allocation, a portfolio that has different assets. This is less relevant from the perspective of investors who are isolated in one asset class or have a bit like some of my clients in one sector or subsector of the equity market. Obviously you think about firms like Citadel, Millennium, et cetera. And so, when you're thinking about putting this all together from a cross asset class perspective, you do need to understand these dynamics. It's very important to understand these dynamics because a dollar you're wasting in an asset that's going down in price, at the bare minimum, not going up in price, is a dollar you could be allocated to something that has a positive momentum. That's in my opinion of what we need to be trying to solve for as a macro investors. One, eliminate the drawdowns. So when I see a drawdown coming from a perspective of what a negative expected value might look like, I'm not going to be overly allocated to something that I know has a negative expected value of the regime. Now, it could still have positive price momentum, and that could be confirmed by the volatility signals that we built. But the reality is I probably shouldn't be there because that could change. Or at the bare minimum, if I'm there in a very limited amount of size, and I need to have a really damn good reason for why I'm violating my own rules. Again, this process is not perfect. This process is not the end all be all for macro. I certainly don't think many people have macro figured out. It's very hard to figure out. I'm only offering what I think is an appropriate framework for evaluating macro risk across asset class and how to piece them all together. Again, there's a lot of work to be done in this direction. There's a lot of work to be done in a lot of directions. But the reality is when you think about crypto, it's been on the tears because the economy's been in my opinion, from the perspective of our models, we've been in reflation and it hit or miss Goldilocks for the last year. When that changes, we'll see how much, people really want to buy that first big drawdown in Bitcoin, Ethereum, and the like.
If you had to summarize what it is that you do at 42 Macro for investors, and I think traders as well, I definitely want to include traders in there because for someone like myself, understanding these themes is big. You don't have to be a long-term investor to gain a lot of knowledge and help in your trading with what you show us. But summarize what it is that you do and what the trader and the investors are getting from you.
Yeah, thank you. I appreciate the opportunity, Anthony. So I would say the number one thing I do is I'm a weatherman. I'm going to tell you if it's going to be sunny, it's going to be cold. And, the beauty of the models that we built here is we have a pretty good lead time with highly precise, accurate views on growth, on inflation, how those things are likely to impact policy, and more importantly, when these things are likely to start to shift. When are you going to start to see these intermittent bouts of volatility? Now, this table right here is tracking and triangulating all the macro regimes, the macroeconomic regimes across all the OECD economies. And it's telling me that I should be on high alert for something changing in the May, June, July time period, right? We go from bright green and dark green across this entire table for basically a year to a different color. So that tells me that if I've been doing a lot of the same stuff for 6 months, 9 months, 12 months, I need to start to think about putting a different pair of clothes on or putting different pants on, a parka on or something. Do something different. And that's kind of the function that the weatherman has, right? Well, it's not even weatherman now, it's all apps now, but if it's raining, you're not going to go outside in a tank top and flip-flops. If it's snowing, you're certainly not going to do that. And if it's really bright and sunny, you're not going to go outside in a parka. And that to me, what 42 Macro really provides is hey, these are the clothes you should wear according to where we are in the market regime cycle and where we are in the macro regime cycle. We're not going to get it all right. You're not going to be decked out in Louis Vuitton and Gucci every single day. Because again, this game is hard. It's very difficult. But I think we're going to do a lot better than bad because we're armed with data and we're armed with the humility not to disrespect the market.
Yeah, like I mentioned earlier, this is one of the things that I really like about your work is that you're very present with market conditions. That's why I believe it helps investors and traders. You have to understand what theme, what regime we're in, what are the signs that it's changing, what could be or what is set to be the next regime. Whether you're a trader or an investor, this to me it's of extreme importance. I am more of a technical trader, but a lot of my ideas and my themes go back to what is the macro theme, because that big train is going to run you over. I don't care what your charts tell you. I've been through this and I fought this for years, saying the charts are all that matters. This is what it's showing me. And all of a sudden, this big macro train will come in and just run you over. Mm-hmm. And especially if you're in commodities, I think stocks, there's different things that have happened with stocks over the years, with the Fed and stuff, but you have to understand that stuff. It's still extremely important to get it and to understand these things. And you do an absolutely wonderful job of explaining this to traders. Is there something free that the traders can go to? Give us a website to go check out. I know you changed your Twitter handle as well. Give us that, and maybe a place where they can go get some free info or content that you put out.
Yeah, you know what I'll do? I'll just tweet something out today. You guys can all follow me at 42 Macro D Dale, DDALE, 42 Macro D Dale. We also have a 42 Macro handle as well. I tweet out a lot of updates from my research as well. So what I'll do for you guys, I'll just publish something for free on the Twitter so people can check it out. Got it. Perfect. So go to the Twitter stream there. Website, I'm sure that'll be on there as well. Twitter's, that's where we're all at. Right there he is. It's funny. Absolutely, man. Dude, I love it. There's so many really freaking smart people on Twitter. You just get all this information if you look for it and find the right sources, and you're a smarter person from being on the platform. No doubt. I read it every morning. I've actually started to follow a lot more people. I was at first not following as many people, and I started to follow a lot more people, especially now that I've been doing more crypto. I mean, there's so many accounts that I followed and had unfollowed. They're not really giving, some of these crypto accounts have huge followings, and you're kind of like, okay, let's see what they have to say. And you're like, this is it's kind of a strange account, but that's for another different day in conversation. But Darius, what do you do? You know what I do? When I do, before I follow anyone, I just give it a quick scroll, look at their last 5 to 8 tweets. If I need to see at least 50% charts. If it's just people tweeting about what they ate for dinner or ranting about politics, I'm like, you might be brilliant, but this is not going to be good content. I don't need this content. And I can turn on TV for that. No doubt. I do that in a sense too as well. And then I end up still following some people to see if they, because sometimes people go on these tangents, even myself, where I'll just be tweeting either my shows or dog pics, but you're just in those moods, and then then you don't want to post anything for a while. But I'm very happy for you and your new gig. I'm excited for you in the future. And traders, give Darius a follow. He's great. He's a good guy, and he does great work. And I always learn something from you. And today, I got to tell you, I really have to say this is. I didn't know what we were going to talk about. I like coming out. We do a little bit of prep for these shows just to kind of, see what topics we're going to talk about, but really changed my thinking today with this reflation to deflation. Plus, I hold a bunch of Ethereum, and you got me sweating a little bit. That's a whole other thing. I'm going to check my charts. Well, the good news is I think we got potentially a couple more months left in the trade, but, when it turns, it's going to turn, man. There's going to be a lot of people waiting to buy that dip because they're already in the trade. Yeah, I know. So, well, cool, man. Well, once again, thank you so much for joining me on Futures Radio Show. Thank you, Anthony. It's a pleasure, man. Appreciate you. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.